Hey guys, welcome back to the channel. Today we're going to be talking about common stock vs. preferred stock. So if that sounds like something you're interested in learning more about, then definitely stick around for the entire video. If you're new here, I'm a CPA, and on this channel, we discuss everything personal finance. So if you're not already subscribed, hit that subscribe button so you can be notified when I upload a new video. Alright, so let's go ahead and jump into the video. Alright, so first things first. What is stock? Stock refers to a share of ownership in a company. So if you buy one share of stock in Apple, for example, that means that you own 1% of the company. Preferred stock is also a share of ownership in a company, but with preferred stock, you typically do not have voting rights. So that's one of the main differences between preferred stock and common stock, which is the type of stock that we most often think of when we think of buying stock. With common stock, you typically have voting rights. You get a vote for who's going to be on the board of directors for that company. With preferred stock, you don't have that right. Another key difference is that with preferred stock, there's a fixed dividend amount. So instead of receiving dividends based on the performance of the company, like you would with common stock, your dividends are fixed. So let's say you own a share of preferred stock in Coca-Cola, and let's say that Coca-Cola pays a 4% dividend yield. If it trades at $100 per share, that means that you'll receive a dividend payment every year of $4. Now here's another key difference. When you buy common stock, you have unlimited upside potential, meaning that there's no cap on how high the price of your stock could go. If you buy preferred stock, however, there is a cap on how high it could go. Typically, it will never go above the par value of that stock. Par value is the value of a stock when it was originally issued. So let me give you an example. Let's say that Coca-Cola has a preferred stock that has a par value of $100. Now that does not mean that the stock will always trade at $100. It just means that that's the original price that it was sold at. That's the par value. So that stock could trade at any given time anywhere from $100 to $110, maybe $120. But it's never going to trade above $100. It's never going to trade at $150 or $200. So that's another key difference. With common stock, there is no upper limit on how high the price of that stock could go. Now let's talk about downside risk. With common stock, if the stock becomes worthless, you lose all of your investment. However, with preferred stock, even if the stock becomes worthless, you still have some value because you know that you're still going to receive that fixed dividend payment. Again, assuming that the company doesn't default on those payments. Okay, so hopefully you're starting to understand some of the key differences between common stock and preferred stock. Let's go ahead and summarize everything in a table here so you can see it all side by side. So first, we have common stock versus preferred stock. Common stock is a share of ownership in a company. Preferred stock is a share of ownership in a company, but you typically do not have voting rights with preferred stock. Dividends are variable with common stock, meaning they depend on the performance of the company. They're fixed with preferred stock. Upside potential is unlimited with common stock, but it's limited with preferred stock. Downside risk is greater with common stock than it is with preferred stock. I know this probably isn't really applicable to people who are only 10 years old, but if you're a little bit older and you're trying to figure out where you should put your money, whether you should buy preferred stock or common stock, there's a simple rule of thumb that you can follow. And it's that if you're a buy and hold investor and you have a long time horizon, then you should invest in common stock. Common stock will give you greater returns over time, but it will also come with greater risk. So again, that's why you need to make sure that you have a long time horizon. You don't want to invest in common stock if you need that money in the next few years, because the market is unpredictable. It could go down just as easily as it could go up. But that being said, over the long term, stocks have historically returned about 10% per year. So that's why, if you're a buy and hold investor and you have a long time horizon, common stock is the way to go. If you want to learn more about the different types of investments that you can make, check out this video up here, where I discuss the differences between stocks, bonds, and real estate. And I'll see you in the next video. Thank you guys so much for watching. If you enjoyed this video, give it a thumbs up, make sure you've subscribed to the channel, and turn your notifications on, so that way you can be notified when I upload a new video. Also, if you know someone who might benefit from this video, go ahead and share it with them. And lastly, if you have a question that you'd like for me to answer in a future video, go ahead and comment below. I'll see you soon. Bye. Hey, you might have heard grown-ups talking about how the price of stuff is going up, or that the government is trying to get inflation under control. But what does that even mean? Inflation is a fancy word for when things get more expensive over time. And almost everything gets a little bit more expensive every year. For example, if you were to go out and buy the exact same candy bar that you bought last year, it would cost you a few cents more. When people say inflation is out of control, they mean that things are getting more expensive faster than they should. And that's not good, because it means that your money doesn't go as far as it should. When this happens, it can be harder for families to afford the things they need, like food, gas, and new clothes for school. It can even be harder for them to afford their rent or mortgage, which is the money they pay to live in a house. Now, a little bit of inflation is actually a good thing. It's normal for prices to go up a little bit every year, because people's wages go up a little bit every year too. So prices going up keeps pace with people's ability to earn money, and it doesn't really affect most people. A little bit of inflation means that the economy is growing and doing well. But too much inflation is a serious problem. For example, if the price of your favorite candy bar goes up 50 cents a year for 3 years, that's not so bad. You could earn some extra money by doing chores around the neighborhood, and then use that money to buy the candy bar. But if the price of the candy bar suddenly jumps to $3, even though it used to be $2.50, that's a big problem. Doing chores around the neighborhood isn't going to make you an extra $3 anytime soon. And now you can't afford the candy bar anymore, even though you used to be able to. That's how too much inflation can keep you from buying the things you need and want. Inflation happens because of many things, including low supplies of things people want to buy, high demand for certain products, higher wages, and even the cost of shipping stuff. Sometimes these things cause prices to go up a little bit. Other times, they can cause prices to go up a lot. The government wants to keep inflation under control for 2 reasons. First, they want people to be able to afford the things they need. Second, they want the economy to keep growing nicely. To do that, the government uses something called the federal funds rate. This is the interest rate that banks charge other banks when they lend each other money. When the federal funds rate is low, people and businesses borrow money and do things like buy new houses or open new businesses. That helps the economy grow. But when there's too much inflation, the government raises the federal funds rate to try to slow down the growth of inflation. That makes it more expensive for people to borrow money, and that slows down the economy. The goal is to get inflation under control and keep the economy growing nicely without slowing it down too much. It's kind of like riding a bike. If you're going too slow, you have to pedal faster to go faster. But if you're going just right, you don't have to pedal very fast at all. The government wants to keep the economy from going too fast or too slow. Sometimes the government has to raise the federal funds rate a lot and quickly to slow down inflation. That can cause problems. For example, if people aren't able to buy homes because interest rates are too high, that could cause the economy to slow down too much. So it's a balancing act for the government. They want to raise interest rates enough to slow down inflation, but not so much that they cause other problems. It's hard to get this just right. And sometimes the government makes mistakes. But that's why they have people working for the government whose job it is to figure out what to do about inflation. Hopefully, they'll get it right, and you'll be able to keep buying the things you need and want without having to earn a lot of extra money first.